Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. I'm Michael Bull, your host to the world of commercial real estate. Today, we're looking into the hospitality industry. You might be surprised how well this sector is performing. Please welcome my first guest, Mark Woodworth, President, PKF Hospitality Research. PKF manages a database of hotel properties' income statements and sales prices. This data provides a foundation for their e-business and their custom research services. Mark, welcome to Studio One.
Michael, thanks. It's good to be back. In fact, I've been back so many times now, I'm wondering why are you inviting me, because you must know it all by now. But I'm glad to be here.
No, you're an expert. We love hearing your opinions and know what's going on in the hospitality market around the country. So thanks for joining us. And speaking of that, you were just in Los Angeles, right, at the America's Lodging Investment Summit, which is the largest conference of its kind in the world. So what was the mood there? What were people saying?
Lots of happy people. Very happy about a number of things, starting with just the fundamentals of the industry. We think about the relationship of supply to demand and where that's now brought occupancy levels from the depths of the downturn really in 2009 to we're now back to long run average, which is an important milestone in the industry, which has returned pricing power to hotel managers. And so room rates have been going up at a very attractive clip, particularly when we think about it in real room rate increases, given how low inflation has been. And those strong rate growth and high occupancy levels have led to some very, very attractive year-over-year gains in profitability. And perhaps the best news is that's expected to persist at least for the next 2, probably 3 years. And there's a high level of comfort and widespread belief that what I just said is actually true. So lots of happy people.
A lot of smiles on their faces.
A lot of smiles.
That's right. So how much better was the move than just last year?
I would say there was a lot of what I just described was present a year ago, Michael. I think probably the most noticeable difference is that liquidity has now become a little more prevalent in the domestic lodging industry. There are a lot more lenders at the conference this year than what we saw a year ago.
They weren't hiding?
They weren't hiding. Well, a few were, but most were not. And as you would expect, they were very popular. People wanted to talk with them. And the terms that we're seeing on hotel debt, while still some might say onerous relative to what we saw back in 06 and 07, when liquidity was just arguably maybe it was too liquid. But they're certainly not, as from a borrower perspective, they're better than they were a year ago. So which again, that's kind of fueling this notion of as the cycle progresses, we're getting closer to a point in time where more new development deals will be getting done.
Yeah. So investors and lenders really like the sector now, don't they?
They do, and again, a lot of it has to do with the strength of the fundamentals. But I must say that of the lenders that I met with out in Los Angeles, without exception, when you say what's most important to you, it's the relationship. Right. It's the track record of the borrower. That has to be there for us to really want to understand really what is the opportunity that relationship is bringing to the table.
And you spoke at the conference.
I did.
So what did you tell everyone?
I said 2014, which happens to be the year of the wooden horse and the Chinese zodiac, and so those of you interested, look that up and see what that means. But it's
not a Trojan horse.
No, not a Trojan horse, but it is a T year, and the T stands for terrific. And again, and that's really what I open my remarks with, in that if we think about historically what has brought an end to the good times in the lodging industry, and that's everything from an economic contraction to a stock market crash to high oil prices to bubbles bursting or some kind of catastrophic event like a 9/11, like the financial crisis we saw in 08. Obviously you can't predict that last category of what brings an end to the good time, but with respect to the first four, again, there's no threats on the horizon. So people are becoming more and more confident that the good times that we've been experiencing for 3+ years now are going to persist again, at least for another 2 or 3.
Great. So what's that doing to rates and occupancy?
I mentioned a minute ago that one of the key milestones is that we look at long-run average occupancy, and we know in studying past cycles that when the industry gets to and beyond that long-run average level, room rates really begin to power forward. Scarcity becomes more of an issue in many markets. In fact, going back to more of a fundamental approach, of the 50 cities that we track very closely in our Hotel Horizons forecasting effort, last year, according to Smith Travel Research, in 44 of the 50 markets, more rooms were sold than they've ever been sold before. With maybe 2 or 3 exceptions, new construction, new supply is nowhere near a threat to those markets. So again, painting a picture of not only is we think in macro terms for the industry as a whole, is the picture looking good, but in the vast majority of the major markets that make up 50 to 60% of the total industry, again, those fundamentals are very solid. You have places like New York that are going through some very significant supply increases, not to the point that we think it's going to be catastrophic, but you have other markets like Washington, D.C., where there are some fairly sizable new projects coming into DC, and there's a lot of issues now on the demand side of the equation, i.e. starting with federal government and spending and so forth. So that's one of the few markets where we think there actually could be a contraction this year versus a year ago. So I know, as you know, that it's all street corner business. So as you look at the industry and look at opportunities, you really have to understand what's going on in your particular neighborhood.
Yeah, and also I guess in the sector of the hospitality industry you're in. So what do you see for performance differences between full service hotels and maybe lesser service hotels?
One of the things that is different about this particular episode that we're still working our way through is that the higher your room rate, the better you've been doing. So i.e. luxury hotels were the first to fully recover in terms of their occupancies and RevPARs and so forth. Conversely, economy budget properties have been the slowest to recover. What we've learned, again, that was very different about this particular go-around is that the demand for higher priced hotels, upper priced hotels, correlates much more closely to things like real personal income levels and corporate profits, i.e. those that have the resources to spend do. Conversely, lower priced hotels, that demand tends to correlate much more closely with changes in employment. And as you know, the whole employment side of the recovery has really lagged. So that's hurt that lower price segment of the lodging industry.
Okay, so your forecast is pretty rosy then. I mean, you have very little new construction still, except in some of the markets. You have improving rates in occupancy, so
growing profits, right?
All right, so we should be all doing the Snoopy dance for the next year.
At least the next year, and we believe it really is 2 to 3 years. In fact, if time allows, I mean, when I go to these conferences, I do like to come loaded with a question. And when I meet people and so forth, and in fact, just outside, I was talking with David Marvin. I know your next guest is going to be in here, and I posed the question to David, and that is, what do you think the industry is going to look like in 2017, 2018? And I'll give you 3 choices. It's either going to be good, it's going to be bad, or it'll be average. Now, the consensus view from those that I asked out in LA was clearly average, with a bias towards the negative. And so in trying to understand why is there this slight negative bias to your thinking, the consistent response to that was, well, that'll be 10 years from peak to peak. And i.e. the last peak was in 2007. And with respect to the hotel industry, history says that cycle typically runs 7 to 10 years, much more closely to 7 than 10. So we're on the long end of the range. So it's kind of interesting to see people's perceptions about, again, what they think the world's going to look like, primarily because if you're getting ready to build a new hotel today, you're going to be opening pretty close to that 10-year point in time. And so we think it has some implications about how you structure your capital stack and how you plan to move through that phase of the cycle, if in fact that arrives in 17 and 18.
We're short on the break, but with this lack of new construction that we've had overall, might we see a spike in improvements this year? And rates and occupancy, or?
Oh, absolutely. In fact, it's the point now where in many markets we're seeing that economics 101 principle kick in, and that as prices go up, demand will go down. So because operators have been able to successfully move their room rates to a point where some travelers are saying, look, I can't afford to take a 3-night trip, I'll make it 2, or 2 becomes a 1, and so forth. So that ends up manifesting itself in slightly lower occupancy, but very, very healthy price growth.
Yeah, well, that's interesting. Stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Atlanta Office Liquidators, new and used furniture liquidators, France Media, publications and conferences, and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.